Today, we will talk about the dot-com bubble. The dot-com bubble was a rapid rise in U.S. technology stock equity valuations fueled by investments in internet-based companies during the bull market in the late 1990s. The value of equity markets grew exponentially during this period, with the technology-dominated Nasdaq index rising from under 1,000 to more than 5,000 between the years 1995 and 2000. Things started to change in 2000, and the bubble burst between 2001 and 2002 with equities entering a bear market. The crash that followed saw the Nasdaq index, which rose five-fold between 1995 and 2000, tumble from a peak of 5,048.62 on March 10, 2000, to 1,139.90 on October 4, 2002, a 76.81% fall. By the end of 2001, most dot-com stocks went bust. Even the share prices of blue-chip technology stocks like Cisco, Intel, and Oracle lost more than 80% of their value. It would take 15 years for the Nasdaq to regain its peak, which it did on April 24, 2015. The dot-com bubble, also known as the Internet bubble, grew out of a combination of the presence of speculative or fad-based investing, the abundance of venture capital funding for startups, and the failure of dot-coms to turn a profit. With capital markets throwing money at the sector, startups were in a race to quickly get big. Companies without any proprietary technology abandoned fiscal responsibility and spent a fortune on marketing to establish brands that would set them apart from the competition. By 1999, 39% of all venture capital investments were going to internet companies. The bubble ultimately burst, leaving many investors facing steep losses and several internet companies going bust. The bubble was fed by cheap money, easy capital, market overconfidence, and pure speculation. Valuations were based on earnings and profits that would not occur for several years if the business model actually worked, and investors were all too willing to overlook traditional fundamentals. As investment capital began to dry up, so did the lifeblood of cash-strapped dot-com companies. By the end of 2001, a majority of publicly traded dot-com companies folded, and trillions of dollars of investment capital evaporated. The dot-com bubble lasted about 2 years between 1998 and 2000. The time between 1995 and 1997 is considered to be the pre-bubble period when things started to heat up in the industry. The dot-com bubble burst when capital began to dry up. In the years preceding the bubble, record low interest rates, the adoption of the internet, and interest in technology companies allowed capital to flow freely, especially to startup companies that had no track record of success. Valuations rose and money eventually dried up. This led companies, many of which didn't even have a business plan or product, to collapse, causing the market to crash. Here are 5 key takeaways. 1. The dot-com bubble was a rapid rise in U.S. technology stock equity valuations fueled by investments in internet-based companies in the late 1990s. 2. The value of equity markets grew exponentially during the dot-com bubble, with the Nasdaq rising from under 1,000 to more than 5,000 between 1995 and 2000. 3. Equities entered a bear market after the bubble burst in 2001. 4. The Nasdaq, which rose five-fold between 1995 and 2000, saw an almost 77% drop, resulting in a loss of billions of dollars. 5. The bubble also caused several internet companies to go bust. Hope this would help. Thanks for watching.